We are recording, so I think we're good to go. All right, so today is Monday, January 14th. We are well into the year now, and lots of volatility in the stock market. So, Trav, man, I'll pass it over to you, and you can kick us off. And we've also got Nikki here who's going to talk about her trade from today, and
Yeah, so last week, just to kind of recap the market's movement, most markets were up somewhere between 2 and 4% in terms of the indices globally. So it was just a continuation of what we saw the first week of January with the market bouncing. And now we're at these levels where, I think it starts to get a little more cloudy in terms of, overall strategy because we do, while the markets aren't super expensive still on an earnings basis, there's still a lot of geopolitical risk hanging over. So we're being really patient with how we're approaching the market and particularly our watch list and our positions. So, in terms of economic data, we had a few data points last week. We got some initial claims data and the CPI data and the Fed minutes, and that was all really in line with expectations. Had a couple of earnings reports last week. Home builders, Lennar and KB reported, those were relatively in line with expectations. A lot of their comments were basically, the housing markets have weakened a bit, but our core business is still doing pretty well, and we expect to still grow in 2019. And those stocks are actually still fairly cheap too, at about somewhere between 7 and 8 times earnings. Those are interesting. I continue to watch those and wait to see if we get another hard pullback. Those might be candidates for a trade.
Wait, which ones?
The home builders. So
okay.
I like Lennar and Pulte, PHM and LEN. And both trade somewhere between 7 and 8 times expected 2019 earnings. One of the reasons why I like Pulte, for instance, is they've been really dedicated to reducing their share count and essentially delivering shareholders the cash that they generate. So they've been really good capital allocators the last several years. Lennar actually is doing a lot of the same things as well. So like both of those. Lennar is a little bigger. But both of those are fairly well diversified too geographically. I know Nikki was looking at Beazer, BZH. And Beazer trades a little bit more cheaply even than those two, but is just a little bit less diversified geographically. So we're kind of both watching those stocks. And they had decent reports last week, nothing really out of line with expectations. And the home builder stocks have rallied a bit in the last 2 weeks. So I'm just kind of waiting for another good entry point if we can get another hard market pullback there.
Nice.
Other macro related things, China, trade talks with the US were reported to be fairly positive, but still a lot of unresolved issues there, it sounded like. So they're going to continue talks, and the Chinese representatives are going to come to the US in the coming month. So not a whole lot of resolution there. So that's still overhanging a bit. The government shutdown really is the big, in the US is one of the big things that's still weighing on sentiment. With the government remaining shut down, now you've got people missing paychecks. You've started to see some issues at airports with TSA lines being shut down. And so they're starting to see some trickle of impact into the general economy, although relatively muted impact so far. That's something we're keeping an eye on, and that could get pretty ugly politically. So that may give us an opportunity. There's some earnings reports that get started this week. We had Citigroup today. Again, it was another report where relatively in line with expectations. They were a little bit light on revenue, but overall, profit was met or slightly beat expectations. We get a bunch more banks and financial reports this week, so that'll give us another good read on how the macroeconomy is doing. So we get Wells Fargo, JP Morgan tomorrow. I know later in the week, I believe we get Bank of America, Goldman Sachs, American Express, Morgan Stanley, State Street. So there's quite a few financials that report this week. We get a couple airline reports in Delta and United. Those will be interesting to watch how they're thinking about capacity additions and just general economic outlook. And then Netflix is a big report in terms of the tech industry. We'll get Netflix reporting earnings Thursday after the close. So this could be a big market mover. And we're going to be watching how the reactions to Netflix's earnings reports really shake out. It'll tell us a lot about expectations going into the full-on earnings season, which really starts to begin next week and week after. We'll start having 50 to 100 companies reporting earnings a day by early February. So that'll be really important time to be, for us to be paying attention and potentially even taking some trades on some of these positions.
Netflix has had a pretty gnarly bounce since the lows too. Let's see. Yeah. Wow.
Yep.
Look at that.
Netflix has had a huge bounce. So
yeah, they're kind of at a pivotal area too, because this is either going to turn into a big head and shoulders, or if they beat maybe a gap up, like a gap and run.
Mm-hmm.
Yeah.
Yep.
Cool.
So yeah, and other than that, you've had you've got some funky stuff happening in the UK around the Brexit vote. So could be some issues there happening in Europe. The PG&E bankruptcy or likely bankruptcy in California was an interesting piece of news. That stock was down 50% today. But I don't expect that to really be a contagion event. It doesn't look like it is so far. So, so it's a little bit more of a quiet week this week so far. But again, as these earnings reports pick up, we're going to have a lot more opportunities in single stock names for trades. So that's kind of how we're looking at things from a broad level view right now.
Nice.
The quiet before the storm, basically.
Yes.
Yeah.
Indeed.
OCY asked, what would trigger a buy in BOL? Isn't this one a pretty good buy already, given that it trades at a fraction of its assets?
Yeah, it's a great question. Yeah, I do think BOL is a good candidate here to start buying. And the only reason that I didn't really issue a trade alert was because there wasn't anything, any real news in the near term, and I have expected that there's going to be some market volatility for us to take advantage of some even lower prices. But honestly, for a longer term time frame, especially like a 12 to 18 month time frame, I think even starting to accumulate BOL here makes a ton of sense. I own some at a cost basis that's pretty much in line with today's trading price. And like you said, the discount to net asset value is near its historical high. So there's a lot to like about Bellora here. And I think you will do well if you do want to accumulate some here. So I really just didn't issue a trading alert on it yet because I'm kind of waiting and watching and trying to be a little bit patient with this market overall.
Travis, is this chart right? Are we sitting around threes? That looks really weird.
Yeah, that looks right.
Okay. So it had, was there some kind of something funky with the split?
Yeah, there was a split there.
Oh, okay. Okay. That makes sense.
Yeah, so.
Cool.
But so that's an interesting one. And, a couple of the stocks on the watch list, if you've read through it, I think are interesting at today's levels. But again, I'm being a little bit too conservative in terms of being patient and waiting for the pullback. But
BOL?
Yeah, BOL obviously, but also I think Criteo, CRTO is pretty interesting at these levels, and I think could make some sense to start accumulating even here. I was going to talk a little bit more about that one today. In a little bit, we can get into that, but. I think some of these are ripe for trading even now. So I think Fiat Chrysler is another one, FCAU. Again, I think that's the kind of name that you can get 10 to 15% cheaper on a big market pullback because it's fairly economically sensitive, being in the auto manufacturing business. But that one's got a really interesting story, backstory that we could talk about more today if y'all want. And they're going to be paying a special dividend of about $1.50 a share in a few months. So you pick up a little bit of income there as well. And the business has been performing pretty admirably with the auto industry as a whole, having really mixed results. Fiat Chrysler has been doing really well and growing its volumes year over year. Jeep, the Jeep brand in particular, and also the Ram brand, the Ram pickup truck was named 2018 North American Truck of the Year, and volumes have been up pretty nicely year over year with the Ram truck. And the Jeep brand actually needing to expand capacity because it's selling more Jeeps than it can even produce right now.
Really?
Yeah.
Wonder what's driving that.
Well, China's part of it. They've got increasing sales of Jeeps in China, but they've been revamping the models over the last several years,
They
and
look
so
a lot better.
yeah, they've got some new models coming out, and they've got the brand as a whole. I think also oil being down helps a company like that.
Yeah.
With gas prices remaining muted.
Mm-hmm.
People are starting to shift into larger vehicles again.
Wayne asked if you can purchase BOL on TD Ameritrade. Do you know if they give you access to the Euro
Probably
exchange?
not. I think last time I looked, TD Ameritrade didn't really allow you to do much trading in foreign stocks.
Mm-hmm.
So you may not be able to. As far as I know, I don't think you can from TD Ameritrade.
Interactive Brokers might be a better bet on that, right?
Yep.
Yeah.
Yep. You definitely can on Interactive.
Okay.
Yeah, oil is pretty interesting. Had about a 20-25% bounce after that just really gnarly sell-off. Wouldn't be surprised to see some consolidation there now.
Yeah, from a technical perspective, is there anything that jumps out to you on crude?
Not so much. I mean, I was interested in a potential dip buy, but I just didn't do anything.
Yeah.
Yeah, I don't know. This one's kind of tough.
Yeah.
It's mid-range, and yeah, I don't see any like real high probability thing that I'm excited about.
Yep. Yeah. Oh, go ahead.
I've just never really been excited about how crude moves.
Yeah.
In general.
Yeah.
For me, but a lot of people love day trading it, the futures contracts.
Yeah, when it's liquid, I just remember getting some stupid slippage back in the day.
Yeah.
Yeah.
It's
Yep.
spazzy.
Yeah, very.
Yep. So there were a couple other things I wanted to chat about, but I wanted to get a feel from everyone who's on the call today in terms of what they'd like us to talk a little bit more about. I know Nikki had a great trade that I wanted her to talk about. Our styles. This kind of goes back to how our styles differ too. I'm more of a find an undervalued stock that can double or triple in the next year or two, and hold it. And Nikki is much more trading oriented. Although I think, Nikki, you've gotten more into the fundamental game as well.
Mm-hmm.
And so Nikki's trade on InBev today was much more of a technical trading setup, which I think was really interesting. So I don't know if you want to talk about that now, Nikki.
I mean, we can just quickly, I'll ask everybody on the call, this is an interesting sector right now in general, and it's kind of popping off, especially with today's news with Canopy, the news about New York, them getting approved to grow. So there's
What happened? They got approved in the state of New York?
Yeah, in the state of New York. I believe it was to grow hemp. Correct me if I'm wrong, but basically CGC, Canopy Growth, has seen a pretty strong bull run or a bounce off of some lows. Chris, I don't know if you can pull that chart up, actually.
Which one?
CGC.
Mm-hmm. Canopy?
Yeah.
I need to add this.
So obviously this is getting a little bit overbought. So I'm probably not so much interested in day trading this until we see a pullback, because that is pretty parabolic there. So I wouldn't be surprised to see that pull back over the next few days. But the reason that I was so interested in NBEV over the past week, I know it's pretty much all I've been talking about, is because from the technical side, it had a beautiful, it was basically consolidating, and it had these beautiful trend lines of resistance and support that were holding. And it finally popped out of that range that it was trading in. It took it a few days, but it's just picture perfect. So I really, really wanted to take advantage of that, especially with so many shorts being involved in this stock. This one and Canopy both have very high short interests. I assume everybody knows what that means from the crypto world, but if not, it basically means that there are a lot of people short the stock, betting against the stock. So when price pops against them, it can just cause all this buying pressure. And that's really what I like taking advantage of the most. So whenever I see these stocks that are technically setting up on the charts, like NBEV, that also have high short interest, I get very excited about those types of opportunities. So I posted the chart. If anybody has any questions, shoot them in there. But I'm monitoring this sector for day trades over the next week to see how it goes. But I want to kind of let the dust settle a little bit because there's been a lot of strong runs. I think NBEV could have another opportunity tomorrow to run into 8. It could actually happen in the pre-market or even in the post-market into tomorrow morning.
Maybe get a gap. And
we could get a
spike.
gap up. Yeah. So if we do get a gap up, it's probably going to be really hard for me to ignore it. And I might continue to look at it for another day trade.
Yeah. So I agree. Like, it's kind of like in Bitcoin, whenever, we see like the long short or the total shorts really high. So like, for example, like right here, the BTC USD shorts is I guess you could call that a ticker. But like whenever you have a lot of people that pile in, that's typically whenever we get around this range, that's when you get like short squeezes. Kind of the same thing can happen in a stock where, when a third of the float is short, and when you're squeezing up against resistance, and then you see like, pre-market or like market open buying activity, that you can get like those pop stop runs. So do you want to talk about like your entry and exit? And then Raz asked, my question is, why day trade it? Buying and holding for 1 to 2 days would have been more profitable. What about just a stop loss?
That's a great question. Yeah. And here's my reasoning as to why and it comes into the fundamentals. It's all about the fundamentals. So I think that a lot of these stocks are overvalued fundamentally wise. And so I've seen things. How many of you are familiar with HMNY? I don't know if any of you guys played around with that.
Is the ticker still active?
Yeah, okay. It's still active. HNMY. When you see price action go crazy, like we did in these marijuana stocks, I'm very, very skeptical and I'm very hesitant. I don't want to hold stocks that aren't fundamentally intact overnight, because news can come out at any time. Say they raise capital and dilute, shareholders. News like that can come out at any time. And so when it comes to these types of stocks, they're simply day trading vehicles for me. But that's my preference. You can swing trade these, and I actually considered holding some of my NBEV trade today for a swing, but I decided against it. It really goes against what I wanted to do with this. So for anybody that doesn't know, HMNY is or was MoviePass. Yeah.
And so what was the problem, and how, like, Nikki, what do you mean like this kind of reminds you of InBev?
And like Trav, you can come in and talk about this too.
Yeah.
To me, I think of just, it's all about the fundamentals, right? Like,
yep.
And what happened with this stock is there were people piling in long, thinking that this was going to be a solid play and a solid company that was going to sustain, and it was going to be as big as Netflix, pipe dreams. And then news came out that they were diluting shareholders because they had to raise more money because they were
so what
running
you're
out of
saying
money.
is HMNY is the Ripple of stocks.
It's actually worse.
Yeah.
It's actually worse than that. Unfortunately, the story of HMNY, I don't know if anyone is familiar with MoviePass, their underlying service. The dangerous part about HMNY was there was an actual story behind the stock. A lot of these stocks, and the same is true of InBev, right? There's this powerful narrative behind it, which is, look, they're in this amazing growing market, and if they can be a big player in that market, they could be huge. Like the story with MoviePass was, all of a sudden they lowered their prices from like $50 a month to $10 a month, I think in late 2017, and they had like more than 2 million subscribers. And so the whole thing with MoviePass was, look, you pay a monthly fee and you can go see more or less an unlimited amount of movies at your local movie theater. And, there's some wrinkles to how that worked actually in practice, but basically they would, you get a preloaded debit card. But what happened was they weren't charging enough for the service. And the thinking was similar to Netflix, that the idea was to build a big subscriber base, and then they'll figure out different ways to monetize it. And a big part of that was, they're going to be able to share concession revenue from movie theaters because they're driving all this new traffic to movie theaters. Well, the fortunate thing about HMNY was that it was run by a really overly promotional management team that was really bad with capital allocation. And so to keep funding their business losses, instead of a great plan about how they were going to improve monetization, they just kept raising capital at lower and lower stock prices. Mm-hmm. So they were just diluting shareholders over and over and over. And eventually, they ran out of money. They ran out of the ability to keep diluting shareholders, and the stock essentially is at zero now. It was almost a total loss. And so even despite having this great story and having millions of subscribers that joined the service in a very short amount of time, they blew the opportunity because bad management team, bad capital allocation strategy. And I'm not saying the same is true of InBev, but with stocks like this, especially with, business models that are undergoing like rapid change, and you've got a management team that's essentially been at the helm of what was a more or less a penny stock for a long time. Now all of a sudden these management teams get this greed, and they're like, hey, we can sell this story to investors. We can just keep raising capital and diluting shareholders, and we'll just use this sexy story that we've got behind us to do that. And as a shareholder, you can really get screwed in those kinds of situations
quickly, overnight.
Yeah.
And you never know when it's going to happen. So I'm just a little, I guess I've just seen a lot of these different scenarios in the past, and I'm hesitant to hold these types of stocks.
So I guess, just to clarify, like whenever we talk about like fundamentals and like what makes this risky, is the fact that it's a company that their market cap is about $500 million. They're actually, so they're selling about $50 million a year worth of these weed drinks, but they're still losing money, right? So like the reason why this is trading at such an expensive premium is because people are forecasting that like this is going to be the, one of the best performing like weed stocks. But what happens is like when you have a sector like this that is like highly speculative and you have a lot of dumb money in it, guys, it's kind of like an altcoin season where you have a bunch of people like throwing money at shit coins. You'll have real companies, right? Like this is a real company with real revenue and real growth, but it's trading at stupid valuation because it's just such an emotional stock, right? So when you have a risky play like that, the thing with the stock market is it closes overnight. So like you could wake up, if you're holding a swing trade, you could wake up the next day and see in the pre-market that the stock's down like 40% overnight. So kind of a way to eliminate or at least reduce some of that risk is with a day trade. So like, Nick, you want to talk about like the intraday action here and like when you got in and out and all that?
Just real quick, by the way, their revenue is mostly from kombucha and coconut beverages today.
Oh, really?
So
okay.
that's part of this, is that like they're selling the story of how they're going to be a player in cannabis beverages, which they did buy a cannabis beverage company.
I was going to say $50 million is a lot of weed drinks.
Yeah, most of what they're selling today isn't cannabis drinks. So
okay.
So that's one of the things that like is a red flag right off the bat, is like, oh, they're selling the story that all of a sudden now they're a weed drink company, but their financials,
it looks like they've
really
got, and I did quick math through FinViz, so I could be completely incorrect, but through FinViz, it looks like they've got about 11 million in cash. They're burning about 3 to 4 million a quarter, give or take. Mm-hmm. I did real quick math, so that could be incorrect. I'd have to double check that. But with that said, that's exactly why I'm hesitant about these companies, is because they don't necessarily have the cash on hand for very long to cover their burn rate.
Yeah.
But back to the trade, you said you wanted me to kind of talk about this a little bit. Mainly I'm trading off of the daily. Was I was pinpointing my entry on the 2 minute, but I was really using the daily to
For the
do
trade,
this
yeah.
because you can obviously see this breakout of that trend line of resistance, and it was clean. It opened right above it. It just had everything going for it. So I bought pretty much right off of the open.
Mm-hmm.
I waited for the open because you never know what's going to happen when that bell rings. So I like to wait instead of anticipating it and buying in the pre-market and then getting run over. So I waited for the open, and I bought when we saw price pop a little bit, and I just kind of rode it out all day. As far as my management, I'm a very patient day trader. I will literally buy something and set a stop loss and let it ride. I'm confident in my risk levels and what I'm risking on a trade, so I'm okay with kind of being patient and going and doing something else while it plays out. But this one ended up being, I'd have to do I don't know the exact number. It was up like 17% when I got out. So I got the meat of the move. So I would say 15% minimum on this one.
Beautiful.
But by the end of the day, I could tell it wasn't going to move to my next target, which was 8. And the reason I had 8 in my head is because an analyst came out with an $8 price target on this stock. So you have to think about the psychology behind that. I don't know if they posted it yet, Chris, on Finviz.
Yeah,
but,
I don't see it here, but
I forgot which firm it was that put it out. But basically, you have to think about the sentiment and the retail investor and all the hype around this. Everyone's going to look at that analyst rating and they're going to say, oh, I need to buy NBEV. It's going to $8. Mm-hmm. So I see that a lot where price does gravitate to those numbers and then it'll just fall off a cliff from there. But NBEV has such a high short interest along with Canopy Growth. Canopy Growth has an even higher short interest. So they're both definitely stocks to watch for short squeezes that could continue.
Yeah, that's a really powerful effect too, is when you find stocks that have high short interest that, especially if the fundamental story begins to turn in its favor as well, you can often see there's a couple stocks I'm actually watching right now that, like Overstock is one of them, and we've got some crossover there into the crypto world because they're starting up T0, which, as most of you probably know, is one of the STO exchanges that's trying to launch. And they also have a retail business where they ship apparel and furniture, Overstock.com. But that stock's gotten totally smashed, and even still has a really high short interest ratio.
What is the short interest? Do you know?
I don't know offhand. When I was looking, we can pull it up. But yeah, it's.
Holy crap.
Oh, wow. That's extremely high. 51%.
Yep. So if the fundamental story here starts to turn, not only could you get the tailwind from the actual fundamentals itself, but the short interest could very quickly turn that into a high-flying stock.
Like BBBY, Bed Bath & Beyond. I mean, they had a over 20% short interest. And after earnings, it's still going. It's still holding up.
Yeah, I could see a squeeze to 30. Technically, that'd be a double too.
Yep. So that's one to watch, I think. I'm not crazy about the CEO there. He's a bit of a wild card. And, there's talks about them selling the retail business, which there are some rumors that the sale of the retail business could be more than the existing market cap of the company today, which means you're getting the T0 business for free. Now, the T0 business will probably burn some cash for some amount of time. So you do have to factor in some cash burn potential there at Overstock. But the setup there could be interesting. And I don't know if anyone has an opinion on T0, but it's something that we probably should all be paying attention to. Yeah,
it's super early, but they're definitely one of the biggest players. And I know Burn is like hardcore going after the STO space. So
Rab, you asked why does it have a high short interest? That's a good question. I don't know exactly why it's heavily shorted, but I've heard a few bear arguments on it, which are, one, they think T0 is not going to pan out and it's going to burn cash and just be a hole in the company's balance sheet. Two, that the retail business isn't isn't worth more than 300 to 400 million dollars. And there's some issues with the CEO selling some of his stake, and so there's a bit of a bear argument. I haven't found anything incredibly compelling, especially if you believe in tZERO becoming a legitimate platform. Then I think that a lot of that bear argument goes away.
Yeah, I mean, that's the risk and the reward, right? Like that is the narrative now, is like, okay, well, we're not going to really compete with Amazon, but we can compete with Coinbase,
Yeah. Vitautas, it's not interest of 51% a year. It's what we call short interest. So it's the percentage of the outstanding shares that are shorted. So, anything above like 5 to 10% is considered a high short interest. So 50% short interest is incredibly high.
Yeah. Think about it. If you have 30 million shares outstanding and 15 million are short, that's a lot of people that need to cover, right? Think about that, guys. Anybody, like, if the more people that are in a short position in a market, that's actually bullish pressure on price at some point in the future, because those people are at some point going to need to cover, meaning buy back their shares.
Yep.
And there's a metric called days to cover, which basically says, like, if all the shorts covered, how many days would it take for all of those shorts to do so?
Yeah. Cool. So this is definitely
I think
an
Overstock is at 7 days to cover, if I'm reading that right. But yeah, so.
Yeah, you could get a real quick pop in Overstock.
Yeah.
I don't know exactly what that catalyst will be. I know that they were trying to close a private investment in tZERO. Like, there was a Chinese investment firm that was supposed to give them a couple $100 million in capital to own a partial stake in tZERO, which was going to give Overstock the cash to withstand any cash burn over the next couple of years while they build out tZERO. But that investment from the Chinese investment firm hasn't closed yet. So I think that's part of the short interest story as well, is that, hey, this tZERO thing isn't going to actually get its funding. And the CEO still believes that deal is going to close. And he also has said on the conference call that he thinks that he's got some backup options. Now, whether or not you believe him is one thing, but that could be part of the story as well. So one catalyst could be if that Chinese investment firm completes their investment in tZERO and Overstock gets that cash on its balance sheet, that could send the stock up probably 20, 25% in one day.
Yeah. And I think Overstock was kind of a sympathy play on Bitcoin too. You'll notice when, it basically went parabolic with Bitcoin at the end of 17 and then topped out right around where, or a little bit after where Bitcoin did. And so maybe there was, some shorts that piled in there too. But, coming off of that kind of that V top, it doesn't have to just reverse right away. Like, you can see, like, historically, it can get real choppy in between like 10 to 15. So, I mean, I don't think, for me at least, this isn't one that I'm just going to buy just based on the fact that it's heavily shorted. Like, I'd probably look for, I don't know. It's tough to time it, right? Like, there'd have to be some kind of news catalyst.
You'd maybe have to pay for some confirmation.
Yes.
In the reversal of the trend, like wait for the news and then.
Yeah.
Jaka asked if Overstock is a potential buy. I think what you said is right, Chris. It's not a stock that I feel comfortable buying and holding for the next 2 years, but I think it's a trading opportunity where if you get news or you start to see some momentum, then it could be one of those trading opportunities or swing trading opportunities.
Yeah. Like, if you catch a setup and say there's like a gap up and then an intraday setup, you could do anything from a day trade to a maybe a 2 to 3 week swing, maybe for a 30 to 50% move.
Yep.
But again, I look at this as kind of a higher risk one for sure.
Yep.
Yeah, Brett, I agree. I mean, I think that's what, if I had to guess, and I haven't talked to Bern about it, but, it looks like that's what he's most excited about. Like, I'm sure the security token stuff is much more exciting than couches for him.
Yeah. Yeah, so, they've said that they want to sell the retail business.
Yeah.
So whether or not there's a buyer is another question, but.
Right?
Yeah.
Yeah.
Retailers are having a hard enough time. I don't know who's out there. I want to buy a retailer and I'm a retailer and compete with Amazon.
I hear Sears is at a good discount right now. All right.
So, yeah, we've got some other stuff we can talk about related to fundamentals. I wanted to address one question that keeps popping up in the community. And a lot of this just revolves around the more broad question of what does it mean to use fundamentals? Mm-hmm. Ultimately using fundamentals means with stocks, we are going to use methods to come up what we believe the share price of a company should trade at, an intrinsic value, if you will, because stocks, unlike crypto, do have ways that you can value them on the business's earnings and cash flow. Now, the true way to value a company is really to look and model out its cash flows for the next 10, 15, 20 years. But most people don't do that. So what a lot of people do is rely on shortcut methods. And so that's where, for instance, like the price to earnings ratio comes from. And that's a question that keeps popping up that I wanted to address a little bit today, which is, what is the price to earnings ratio? When do we use it? When do we not use it? What does it mean? How do you calculate it? It's a widely reported number on a lot of stocks. It's not always the right method for valuing a stock, but it often gives us a good guide for at least a range of where we think a stock might trade. So, the price to earnings ratio there's really two ways to calculate it. You can take the price per share of a stock and divide it by the stock's earnings per share for that year, and that will give you the price to earnings ratio. Or you take the market cap of the company and you divide it by the total net income of the company. So either method should get you to the same number. Now, I will say
say the first one again.
The first one is you take the price per share of the stock.
Yep.
And divide it by the earnings per share of the stock.
Yep. Okay. Cool.
Or of the company. And so that's what you would call like a per share. Both the numerator and the denominator are on a per share basis. And you divide the two. The other method is to not do a per share basis. You take the entire market cap of the company and you divide by the total net income of the company on that company's income statement. I would call that like maybe the aggregate method.
So let's do Netflix real quick.
Yep.
So like if you go to FinViz, you can see here, I'll blow this up so you can see these numbers. But if you come down below the chart, you'll see like, the index, like it's in the S&P 500, market cap about 145 billion. So net income and then sales.
Yep. So, and Netflix is probably actually not the best example for PE, only because they are prioritizing revenue growth over profits.
Yeah.
So
might want to go with Apple or something.
Yeah, Apple's probably a good one. I'll also say there's really two different versions of price to earnings multiples. There's a trailing and a forward. Now, trailing essentially looks at the last 12 months of the company's earnings. So looking in the rear view, how much did the company earn in the last 12 months? And that's what you would use for that denominator.
So TTM.
And that's what TTM means.
Yep, TTM means trailing 12 months. So that's like, what did the company actually produce in earnings over the last 12 months? You take that, you divide the market cap by that number, and you'll get your trailing PE. Now, what's potentially even more useful is looking at a forward PE, which is taking an estimate of what you believe the next 12 months of company earnings is going to look like. So, for instance, right now we're looking a lot at 2019. Like, what do we believe companies are going to earn in 2019? And taking their market cap and dividing it by what we think their net income will be in 2019. And that's called the forward price to earnings ratio. And that tends to be a little bit more indicative of where the share price is headed. You always want to be forward looking in the stock market. The stock market is constantly pricing in what the market believes about the future. So your measures of valuation and what you think a company's worth should really be forward looking. Sometimes we use trailing just to look at, just because the media will quote things and say, oh yeah, Apple's trading at 12 times earnings. Because again, trailing, the exact numbers. Forward is based on estimates. So, but again, I think forward is often more useful.
And then Andre asks, who estimates future profits? Where does the consensus?
It's a great question. So you get estimates from, most of the reported estimates come from what Wall Street analysts. So analysts that work for firms like Goldman Sachs, Morgan Stanley, Citigroup, Bank of America, JP Morgan, et cetera. Those banks want to earn companies' business in their investment banking division. So they have a separate division where they have analysts who write reports on these companies and issue price targets. And they also issue their estimates of what the company will earn over the next year. Now, analyst track records of earnings estimates are not super great, but over time they do tend to, especially if you have a lot of analysts around a given stock, like they tend to, at least throughout the year, by like mid-year, their estimates are adjusted and end up being relatively accurate by the end of the year. But when they first forecast them, probably not the most accurate measure. So we can estimate our own earnings estimates. And that's what we often do when we figure out what do we think a stock is worth. And oftentimes, not only are we estimating earnings for the next 12 months, but we're going to estimate what a company's going to earn 2 or 3 years from now and look at what the stock is valued on based on like 2020 or 2021 earnings.
So Trav, would you say is that maybe where you can find an edge sometimes is like if the street or all these analysts and a lot of traders are expecting maybe like low forward PE, and then you're like, no, man, they're going to outperform. And so you make bets based on that?
Yep. Yeah, a good example would be a company like Criteo, which I think I'm going to pull up the estimates real quick. I don't know how many.
You know their ticker?
CRTO. It's a company that the sell-side analyst, track record, they're often late to the party as far as updating their estimates. So they will upgrade companies and upgrade their estimates when companies are doing well. And then when companies start doing poorly, they start downgrading their estimates and downgrading their price targets. But I'm not sure. Actually, Criteo may not have a lot of earning analyst estimates. Maybe Micron would be a good example.
Looks like Goldman downgraded them on the 4th.
Okay. Yep.
From neutral to sell.
Yeah. Just pull up here. I'm going to pull up Micron, which might be a better example. Yeah. So Micron here, when I pull up, at least on NASDAQ, has
MU.
Earnings estimates.
MU.
Yeah. You can see that you've got like 8 estimates for 2019 with a consensus forecast of about $8 in earnings per share. So based on 2019, I think Micron's at around $34 today, $34.67.
Yeah.
So if you divide $34.67 by that, let's call it $8 in consensus earnings for 2019, you're looking at a PE of 4.3, which is really low. Yeah. But I think it's likely that those estimates need to come down for 2019 because Micron's end markets have been weakening and pricing has been weakening. But their 2020 targets are for a consensus forecast is only $5.30. Whereas I believe by 2020, their end market cycle will be turning upwards again, and they could be earning as much as $10 or $12 a share. So, whereas the street thinks they're going to earn $5 or maybe even $6 in 2020, I may think that they're going to earn $10 in 2020. And so the appropriate multiple, if I think the appropriate multiple is 10 multiple, and I multiply it by $10 a share in earnings, I think the stock should be trading at, or I think the stock could trade at $100 in 2 years. So that's where you get that edge. If you have a credible belief or a credible difference in your estimate of what a company can earn, especially more than like 1 year out, that's oftentimes where you can get a differentiated view of where a stock should trade versus the consensus, from the Wall Street analysts.
So basically you would look at that and go, okay, there's a potential, 200% return over the next 2 years. And that's a fundamental position trade or a position trade based on fundamentals.
Yep.
Does that make sense, guys? Is everybody with us on that? Just throw a Y or a yes in the room if you guys kind of understand the idea of like how to value based on price per share. And
we could we'll go deeper through this, especially in the boot camp. But, the true way to value a company, again, like I said, is to actually use what's called a discounted cash flow model, and that would
Yeah.
involve a lot of assumptions about what the company is going to throw off as far as cash flow over the next 10, 15, 20 years. But a price to earnings itself is an accounting measure that's supposed to be an approximation of cash flow. And sometimes it's a decent approximation, other times it's not.
Yeah.
But people use the PE because it's a simpler way than building out a 15-year DCF model, even though technically the DCF model is the theoretically correct way to do it.
Yeah.
So, price to earnings multiples can be useful and the S&P 500, trades at about a 15x average price to earnings multiple. Typically you'll see most stocks trade in the, call it like 12 to 20x range. Now, companies that are growing really rapidly and have really rapid expected net income growth will and should trade at higher multiples. Companies that are shrinking should trade at very low multiples. Companies that are very leveraged and have potential bankruptcy risk should also trade at low multiples. So we can think about relevant ranges for different companies based on how fast they're growing, how much debt they have, and adjust what we think the right multiple of earnings should be. So hopefully that's a little bit of insight into price to earnings multiples, but that's why you'll often hear me quoting price to earnings multiples on stocks, because they are a fairly widely used metric of valuation to give an idea of the relevant range of where a stock should trade.
Yeah. And I'll just say, guys, I know there's a lot of new terminology and like, just the idea of using like earnings to like value a company is something new for a lot of people. In the crypto space, it's like, it's so much more risky, right? So much more vague because most of these products aren't income producing companies or projects, right? Like hopefully some of them will be in the near future. And really, I think the main companies that are actually earning profits and an income in the crypto space are the exchanges for the most part. Like they're the ones that are actually getting a really nice income, and you can kind of value those. And I think that's why Coinbase was able to raise at an $8 billion valuation. It's because, investors can look at that and go, how much are you guys making per transaction? And then, so there's a lot of ways to run the numbers and come up with, what we expect a good value to be and whatnot. And we don't expect you guys to learn all this like right away, especially in just a market update class. But hopefully this is just starting to paint a picture of how you can value a company and how you can, look at something and immediately kind of know if there's an opportunity, or in most cases where there's not. A lot of stuff has been overvalued for the past couple of years in this bull market, but the nice thing about this sell-off is hopefully that's going to offer more opportunity this year. At least that's kind of my opinion on it. I don't know. What do you think, Trav?
Yep. That pretty much hits the nail on the head.
Cool.
So yeah, when you read through a lot of the watch list, you'll see me refer to things like trading at, sub 15x PEs that are growing at 20 to 30%. Those are the types of situations where, you've got a company that's growing at a rate well above what the rest of the market's growing at with a market level or sub market level PE. Those tend to be pretty good indicators that there may be some value there. So that's why you'll see me talk about those multiples a lot in the watch list.
Nice. Jocko was asking, how do you define stops in these trades and these investments? And I think we should probably define like the difference between like, Nikki, what you did, like a shorter term trade just based on momentum, and then Trav, like a true value play where it could be a 2-year move.
Yeah.
You want me to go first?
Sure.
Okay. So with day trades, I'm usually looking at the low of the day. So wherever the stock, like in this case for NBV today, it opened, it hit a low of the day, and it never saw it again. That is great that happened that way, but it doesn't always happen that way. Sometimes it'll retest the low of the day over and over, or sometimes it'll break down through it. But I use the low of the day, whatever that may be, to establish my line in the sand. And if that low breaks, a lot of times the trade is no longer intact for me. sometimes when stocks gap open, like today we saw this one gap open. I should have shown the one with the pre-market action, but this is showing without any of the pre-market action. So we saw the gap up, and sometimes price likes to run and fill gaps. Do you guys have that in crypto, right?
Not really, because the markets are open 24/7.
Oh yeah.
Like the futures markets, sometimes you'll see gaps, but for the most part, it's more like Forex where you 24/7.
So basically, in our world, we see a lot of gaps, and price likes to run to gaps. So if I see that potential there, I might put my stop underneath wherever that gap fill could be. So that's how I established day trades. Travis, what do you do with stop losses on investments?
Yeah, it's tricky. So a lot of fundamental investors don't actually do stop losses. And in the past, I haven't either. Although I would say I use a little bit of a slightly different framework. With fundamental investing, oftentimes, again, you come up with a price at which you think a stock is worth. So if the stock declines 10 or 20% and you still think the stock is worth, that higher price that you believe it is, then you actually view that as potentially a buying opportunity to increase your position size. Now, I will say, and that runs very counterintuitive to what a trader would do, which is to cut out that, a 5 or 10% loss. I will say if a stock is losing value and I don't understand why, oftentimes I will cut it around a 10% level, 10% loss. Now, if a stock is declining and I understand the reason why it's declining, I understand why the sentiment is negative, but I don't think it's justified, then again, I may not cut the position. I may actually use it as an opportunity to accumulate and get more of that stock at a cheaper price. And part of that too has to do with the fact that I'm identifying undervalued opportunities, and a lot of times the market hates those at the time. And so there's already a lot of negative sentiment. And so another 10% decline is kind of expected. And I don't expect my first buy in a given stock to be the very bottom of that stock's chart. Mm-hmm. So for me, if I'm taking a view that's 12 to 24 months out, a 10% move isn't really going to shake me out when I expect to make 2 or 3x on a stock.
And I would compare that. I would compare fundamental. Maybe this will help some of you guys too. For stock, fundamental investing is equal to accumulating a crypto, right? Like the accumulation plays that we have in crypto, right? Guys, like how we talk about, if you freak out on a 5 or 10 or sometimes even 50% sell off, that's not an accumulation play. Accumulating is you want those bottom barrel prices, and you're probably going to end up in a drawdown. 9 out of 10 times at some point that trade's going to be in a drawdown. Where with I would say stock momentum trading, which is what Nikki did on InBev today, that's more swing trading a crypto, right? Where you set your risk to reward. You know why it's moving, you know where your targets are, and you know when to cut off. The only, I would say, major difference between a stock and a crypto trade like that is stocks trade a little bit differently in that there's market open and market close. So the market opens 9:30 Eastern time and then closes at 4. And so you have pre-market trading and you do have some post-market trading as well. But for the most part, overnight, you don't have to worry about a trade moving against you. But when you wake up the next day, you can have gap ups or gaps to the downside. Mm-hmm. So that's kind of there's pros and cons with that. I like trading a 24-hour market when I know I can watch the market a lot. But if I'm going to be disengaged, there is a benefit to being able to go to sleep and not worry if it's going to dump while you're sleeping.
And there's a big difference in position sizing with a trade, like a day trade versus an investment. When you day trade, you can kind of pile in size a bit easier because you're going to be out. Yeah. You're going to be in and out. But when it comes to investing, you have to really think about the fact that you're holding this thing long-term overnight through news, through earnings. So you kind of have to size for what you're comfortable truly risking.
Yeah. Yeah. Because the risk and reward is bigger. You're just going for bigger, longer moves.
Right.
Yep. And someone asked if I add to open positions on the way up or only keep the initial entry. So yeah, sometimes I will increase the position, especially as I get more research and more comfort around it, even if it's up a little bit. It's this constant adjustment around the fundamentals and my price target and the risk reward. Sometimes if you get new news and the stock is up, 5 or 10%, but the new news actually validates your thesis even more or, increases your price target, then sometimes it can be an even better buy, even at a slightly higher price. So yeah, sometimes I do add on the way up, although I'd say it's probably still more likely historically that I've added on the way down on a lot of things. But occasionally I will add to open positions on the way up. And I'm trying to think about how to use momentum a little bit more in my strategies. And so I'm going to try to incorporate that more as well in terms of adding to strength.
Cool. How liquid are like mid-cap stocks compared to Bitcoin? That's another benefit to stocks.
They're quite liquid. I mean, it's very dependent on the stock in question and the time of year, but mid caps, probably it depends on how you define them. A lot of people define it as like 1 billion to 10 billion.
Yeah.
And that's a pretty wide range. But I think like a $3 billion market cap stock could easily trade. It's not going to trade probably as much as Bitcoin does every day, but it'll trade enough to where most people won't have a problem with, scaling in and out in a given day. Like a $3 billion stock probably trades a couple $100 million a day.
Yeah.
And then on an earnings day, it might even trade as much as $1 billion, $2 billion worth of shares.
Yep. Yeah. I'd agree. A lot of these, like if you guys just look, you can sort by like average volume. But if you just look at like the daily volume, so like, 3 million times, what's the share price? $30, right? So a lot of these do trade a lot of volume.
Yeah. So yeah. And when you look at it as a percentage of the market cap, obviously that's probably higher than Bitcoin is today in terms of percentage of the market cap traded per day, I would guess.
Yeah.
But pretty liquid among mid caps. It's when you get into the small caps and micro caps where, especially as an individual, it can get a little dicey with some of these on volume. But,
yeah.
And penny stocks, which is why I usually stay away from those.
Yep. Agreed.
We got a good question here. To start out, would you say it's easier to pick an industry and focus on that? It's a lot of fundamentals, industry trends that one would need to know. Travis's watch list is huge and spans many verticals.
Yeah, so great question. This is actually a question that a lot of hedge funds struggle to figure out the right answer to. There are funds that have teams of their investment analysts that are specialists. They focus just on a specific sector, and there are hedge funds that have generalists. So as you can probably tell, I was a generalist. The fund that I worked for employed generalists, and we felt like that worked out pretty well because we had a pretty wide net and we would go where there was opportunity. There's just trade-offs, with sector-focused analysts. You've got, sometimes those analysts are working on stuff that isn't interesting and they're deep into the weeds on the given stocks in the industry, but there's just not much opportunity in that industry, sometimes for years at a time. So, for me, I'm more of a generalist. I am confident enough that I can get up to speed on a sector or a company relatively quickly within at least a month or two. I can learn, probably 80 to 90% of what's going on competitively with those companies in that industry. And there's always more to know, but typically it's a forest through the trees kind of deal where most of what you need to know to develop the thesis on something can be learned relatively quickly, and you don't need to be an industry insider. Other times there are, you do need to have someone with sector expertise that can go real deep to get the edge. But
I can relate to this. I felt very overwhelmed at first with all the different sectors and ways you could go with it. I started with retail because I thought that was the easiest thing to understand.
Yeah. And that's what famous investor Peter Lynch always espoused was start with what you know. A lot of times that tends to be, retail or restaurants, or maybe if you're a tech person, you start with tech, software, whatever. But yeah, so I think if you're doing your own research and you're spending some time learning this stuff, it definitely couldn't hurt to start out with an industry focus, especially if you have a really specific industry expertise. Like someone in the channel the other day was saying, I'm in the airline industry. And I'm like, oh, that's actually a pretty interesting sector, because you can look at airlines, you can look at airports. There are companies that literally just are infrastructure plays that own airports. There are aircraft leasing companies. So there's quite a few different even types of companies within that industry, but it also has its own industry lingo and specifics about the industry that you'll be able to figure out pretty quickly because you know it, and you might be able to get an edge. I think especially if you're just trying to learn, I think starting out with one sector might make some sense. But again, if you're going to follow a lot of what I'm doing, then you don't need to worry too much about being sector focused.
You do a good job at explaining in the watch list, really writing it out. So it helps to kind of, if you don't necessarily know the sector that well, at least what you've written out, you can research based on that and see those terms in there and,
yeah, for sure.
Research them.
For sure.
I do have a margin account. So yes, I never hold anything on margin overnight ever.
OCY says, can't find any info on BOL. What exchange was that on?
The French exchange. So BOL, you should be able to get some information from their investor relations section of their website. I think you said that you couldn't find it there, but you should be able to. If you go to their investor relations section, you can click around on the left side, and there's different sections. They have an investor relations report that I was looking at the other day. I can dig it up and put it in the channel, but they also have, they're required to file their financial statements and their annual reports. And so you should be able to Google that as well.
Yeah.
And for instance, get their 2017 annual report. And that will give you more information than you probably even want to know.
Yeah, they've got quite a bit on here.
So you may even have to click over some of these tabs, you click over to 2018, because 2019, they don't really have much information out yet because they haven't filed any financial statements for 2019 yet. But if you click back into 2018, you can see their results and their revenues. If you look through their annual report, it'll give you a lot of detailed background on their business and their holdings, who their shareholders are, who their CEO is. I mean, lots of detailed information. That's something that we haven't gone into yet, but we'll increasingly go into, which is how do you read these financial statements and earnings releases to really know how to find the information that matters quickly? How do you read the financial statements themselves, the notes to the financial statements? There are sections that are more important than others in terms of figuring out how the business is doing. Often that's called the MD&A, or Management's Discussion and Analysis section. And you can go into different parts of the annual report or the quarterly reports and find those. So I also, if you're looking at a site like Seeking Alpha, especially for US-based stocks, you'll often get the transcripts of their earnings calls that you can read through. I find those really helpful to understand what's top of mind for investors and for company management in a given quarter. What are these managers thinking about? What are people worried about? What questions are they getting on these conference calls? Mm-hmm. What's happening in the industry? Oftentimes the management team is discussing that on the quarterly earnings call. So I think, Chris, you're showing, you've got some.
Yeah.
With foreign stocks, it can be a little trickier. Sometimes the transcripts aren't available. So with this one, you probably have to actually call in and be on the conference call. But Chris, if you want to bring up Micron with MU, the stock we were just looking at a few minutes ago, if you're in Seeking Alpha here and you click through on that news section in the right, you can actually click that drop down and click to transcripts. And then you can see that's a transcript from a conference they were just at. You can also get the transcripts from their earnings results. There you go. Yeah, you're clicking on the last quarterly earnings. Yeah, they actually have a PowerPoint presentation that they created for it.
I like when they do that.
Yeah, yeah. Increasingly, especially US-based companies are creating investor relations presentations like this. And I often Google that specifically. I'll say, if I'm looking at a company, I'll type their name and then in investor presentation. Or I'll just type their name and then investor relations, and then I'll go to their investor relations site and look for their corporate presentation. And that often has a really good overview of what the company's about, their recent financials, et cetera. It's a good way to get up to speed on a company quickly.
Mm-hmm.
Yeah. It's awesome that we have access to all this information so quickly.
Yep.
Cool.
Anything else?
Awesome. Yeah. So let's just kind of, I guess, run through the watch list. Was there anything that you were seeing as maybe like a close call or something that was looking interesting? And
yeah, I think Criteo was one that I'm increasingly spending some time looking at. It's actually been mentioned on a couple people's lists for 2019 potential M&A targets. So Criteo is a company that they do a lot of they enable a lot of display advertising online. Mm-hmm. So when you go to CNN.com and you see banner ads or you see retargeting ads, by retargeting, I mean, if you've ever been to like a retail website, let's say you're on Zappos.com and you're looking at some shoes, you're looking at a pair of Vans, and you don't buy it, you close out the tab and you go off and you do something else. And then all of a sudden, a few minutes later, you're on a totally different website and you see a Zappos ad with the exact same shoes that you were just looking at. And it's like, hey, come back and buy these when you're ready. That's retargeting. And that's so advertisers like Zappos, or, if you're a Macy's shopper, or if you're your whatever your product is that you're looking at, if you don't buy it, a lot of those companies are now retargeting you on other sites, and sometimes even the very specific product you were just looking at. So Criteo is one of the advertising technology companies that enables that technology to happen. So they have been pretty, the sentiment on Criteo has been pretty bearish over the last year and a half or so because of a couple developments. With the recent pushback in data privacy, they're one of the companies with GDPR in Europe, as well as Apple's Safari browser, making it more difficult for retargeting companies with a change in their underlying technology. The technology that Apple came out with was called ITP, or Intelligent Tracking Prevention. And it essentially prevented some of the ways that these companies like Criteo are able to retarget you, essentially deleting your cookies or not allowing these companies access to your cookies so that they can track you across multiple websites. So that hurt Criteo's business in the short term. Now, what Criteo has done is they've created some technical workarounds for browsers like Safari, where that now allow them to better retarget you again. They also, they're starting to lap the periods where GDPR had an impact on their financials. So they've sort of overcome that, and they're starting to grow their revenue again. This is a company with a really rock solid balance sheet with, about $400 million of cash, $450 million of cash. They'll have positive earnings growth probably for the next several years. They've got a couple new products that I think that's what's really getting me interested in the story. So Criteo started talking about how they are enabling a lot of their retailer clients to share data privately with Criteo and use that data to do sponsored results. I don't know if you guys are familiar with sponsored results like on Amazon, where you're looking at a product. Let's say you're looking at like a camping tent, and you Google or you type in camping tent in the Amazon search bar. And maybe even type in a very specific camping tent, like, I don't know, what's a brand of camping tent? I'm like totally blanking. But yeah, let's say you were like, see these sponsored results at the top. These are companies that are paying to be at the very top of the product search results on Amazon. Well, Criteo has a product out, which is allowing some of its other retail clients to do the exact same thing that Amazon is doing, but on these other retailer sites. So like Macy's or JCPenney or Bonobos or some of these other retailers that are using Criteo to do retargeting. Now Criteo is like, hey, you know how Amazon's doing this sponsored results thing? We're going to give you the ability to do the sponsored results thing on your site and other retailer sites like you. So they've got a cool sponsored results product that they're rolling out to allow retailers to essentially mimic what Amazon is doing and earn revenue from sponsored results. So they think that's an interesting product that's going to drive a lot of revenue growth. But yeah, so I think the recovery and revenue growth for Criteo, plus the fact that it's at a really low valuation, it's been washed out, and sentiment has been pretty negative. If you get an increase in the multiple and an increase in earnings from Criteo, you could easily see the stock double in the next year or so. So I think Criteo is getting more and more interesting to me as I learn more about some of their new product initiatives.
So are you waiting for something to happen in the short term before taking on a position, or are you still doing work on it?
Yeah. So I was kind of just being greedy and hoping that we would get another sell-off and I could own it at like $20 or slightly under $20.
Mm-hmm.
But realistically, I think today's a good value, and I have bought a little bit around $25 a share. So a very small starter position. I think you could do very well from today's level over the next year or two. But I'm just being a little bit stingy too in this market environment and kind of waiting for it to come back down on a market sell-off.
What kind of company do you see taking them over, acquiring them?
It's a good question. I think private equity would probably be the first line of acquirer here, because they could take this unlevered balance sheet and lever it up and just do a very classic private equity type of deal. It's one of those companies where, it generates cash. So for private equity company, they love to see companies that they can put debt on, that generate cash, that can pay that debt down over time, and that they can then sell a couple of years later or take it private or take it public again. So private equity, this is like their wheelhouse. I guess potentially you could see another large player, large technology or software player acquire them, but probably not the most likely thing, since like Google and Facebook, for instance, have their own advertising platforms. Amazon has their own advertising platform.
Mm-hmm.
This, a major like advertising company or advertising firm like a Omnicom, WPP could potentially be an acquirer here as well, but those companies don't have a ton of capital right now to do that. So, it's hard to say.
Cool. Awesome. So you have a starter going there. And then just kind of watching, I guess, the broad market, you said, kind of looking for.
Yeah. And I think, let's see, I can roll through these real quick to see if there's anything. Yeah. I mean, I've talked a little bit about MEI Pharma. That's another one where I think today you could, potentially, if things work out for this company, MEIP is the ticker, you could have a 5 or 10x from here. So
they're already in phase 2 with one of their.
Yep.
Right.
Yep. And so we're going to get a lot more data on at least 2 of their drug candidates this year. And that'll de-risk it somewhat, but the stock should probably trade at about $10-$12 today. Trades it, given what they have in terms of their potential pipeline. But
yeah, I remember trading this one back in the day.
I've day traded this a bunch.
It's a pop and flopper, right? It's like every time it runs. It's kind of like the early days of Ripple. If you guys look back at like 2016 Ripple, it'd do this. It'd pop, and then it couldn't like really break out and do a higher high. It actually did that right here, though, for the first time. Had a breakout, did a higher high, but then it faded right back down. So, yeah, it looks cheap. What's your expectation, or what would your trigger be to get in?
Well, so I am in. I think you can buy under $3. I was, I guess, again, and trying to be greedy and anticipating maybe another a little market dip where I could buy it closer to $2 a share again, where it just gets extra compelling. But, really under $3 is potentially a big win here. I think if they continue to give good data on their drug candidates this year, the stock could easily be $6, $7, $8, $10 by the end of the year. So
Would you call this more of like a speculation play? Like,
Yes.
okay, you're just
Yeah,
taking
definitely.
some money and I don't want to say throwing it at it, but in a way, it's
But it's not blind, because relative to a lot of other development biotechs, these guys have funding for the next 2 years to keep developing their pipelines. There's not a question of funding risk in the near term, at least, and the quality of their drug pipeline is really strong for a busted biotech with such a low market cap.
what type of drugs are they testing?
Cancer, mainly,
Cancer, okay,
cancer. So, yeah, and they have several different candidates treating various cancers or leukemias, but yeah, so they also have a really strong management team. Again, like a former Genentech executive is helping lead their scientific efforts, and when you see something like that with a small company like this, it's really unusual. So they also have some partnerships with some really large pharma companies like BeiGene, which is I think is also publicly traded, multi-billion dollar company. So when you see these small development biotechs, it's really unusual to see, a relatively late stage pipeline with a lot of potential. You've got partnerships with large companies, multi-billion dollar companies. You've got leaders that have, helped build large multi-billion dollar companies in the past. You've got funding for the next foreseeable future. So it's just a really nice setup. Now, again, if negative data comes out on some of their trials this year, yeah, you can see the stock get punished again and be back in the 1s or 2s.
But that's why you manage your risk when you know
Yep.
what you're up against.
Yeah, it's an asymmetric payoff here. You've got potentially like 5-10 bagger upside, and yeah, realistically, definitely some 50 to 60% downside too.
So the bear case for this is whatever drugs they're working on don't work and they end up going bankrupt, right? That's kind of the narrative for a lot of biotech drug companies, right?
Yep.
So then what would you say target wise, maybe $10?
Yeah, I think 2019 target around $10 a share. And but you get some de-risking here if the data continues to be strong on their current drugs. Then potentially that moves up to $15, $20 a share by 2020, assuming the fundamental story remains intact and they actually get positive data.
Yeah.
On their
I
drug.
mean, I'd say that's good risk to reward on that.
Yeah. I mean, and that's the thing with drug companies, like at least whenever I'd look at the charts in the past, like this is what you want to see. You want to be able to buy in like an accumulation range. Like you don't want to buy after a 2-year trend where you have everybody piled in and it's up 500%. And then that's where you get those like, I can't think of any tickers off the top of my head, but I've seen a lot of like biotech companies where they'll have all this anticipation and so much media hype, and then one day you wake up and it's got a nasty 70% gap down.
Oh yeah,
because it's like,
these things will burn
pass.
you if you don't know how to manage your risk on them.
Yeah, this is a small percentage of the portfolio that gets allocated to this for sure.
Yeah,
I like it though. I'm interested in it.
Yeah,
this one and MU and Box really interested me from the watch list. We've been talking about Box forever.
Yeah,
but
yep. Got a question. If we look at the price charts of the major stocks and ETFs since September, so basically the market high, we see the recent trend is down, assuming a big recession is not coming in the near future. How likely is it that the stock market will continue to quote unquote spiral down as compared to a recovery with all-time highs of major stocks? So is the stock market going to go up or down?
Yeah, I wish I knew, right? I mean, I think for me, the bias for the balance of the year is to be up a bit from here. But I think we're going to see more volatility. I think, again, I'm worried about the geopolitical situation in the next month or two, the shutdown, the Mueller reports, things like that. At least here in the U.S., Brexit stuff happening in Britain. Again, I think it's something where we could, if all these risks are mitigated by mid-year, fall timeframe, we could easily be back at 2,800. I'm not convinced on all-time highs, just because we are in a slightly higher interest rate environment. We do have some signs of a little bit of economic weakness and just moderation at least. And it's going to be hard for that exuberance that shot us up to 3,000 to return in full force the way it did, late 2017 when everything seemed to be going great.
I mean, if we make it to 2,800, though, 3,000 is not that far away, really.
That's true,
right?
yeah.
So it could just be the euphoria of it that could just get it there, and then it could fall off and kind of recalibrate around there.
Yeah.
Yeah, there is a lot of potential for a black swan this year, right? Like any one of those issues could I don't know. It's real tough right now. Like,
yeah. I mean, and if you'd asked me, December 24th or 26th, I would have said, yeah, buy stocks because I think the reward to risk favors buying stocks. But now that we've rallied over 10% since then, it's sort of back in that range where I'm like, well,
You can see that hesitation in the price right now too.
Yeah, we're definitely at a line in the sand, right?
Yeah.
Like we had the overreaction to the downside, then Travis got his Christmas Eve buying opportunities.
Lots of presents.
Yeah, dude. And then, a lot of the stuff that you were buying, with the market being back up 10% and at prior multi-month resistance, makes me a little weary of trying to buy stuff right here too.
Yeah.
I'm holding off myself.
Yep.
I want to see what happens here.
Yep.
Yeah.
And that's why I've been patient too to issue any trade alerts, because I'm like, yeah, there's some stocks I like and I think are good values, but will we get a chance to own them even cheaper? Potentially.
Ideally, just looking at the chart on the technical side, ideally it'd be nice to see kind of that pullback to that 2400-ish area. It's kind of hard for me to see it from here. I need to pull up my actual chart.
Talking about like a retest.
Like a retest. Hold on. Let me pull this up. The 2436 pivot basically that we saw. That area, like it'd be ideal to see that pivot hold up. You get what I'm saying?
Yeah.
And kind of see a double bottom off of that. And then that might be a really healthy opportunity there if it holds up. If we come back all the way down to the lows, then that's going to be a completely different scenario.
Yeah. Yep, I agree. I think this week is going to be, because we do have a lot of earnings coming out.
Yeah.
So there's a lot of eyeballs on this zone right here.
Yeah. Netflix will be interesting on Thursday. Not even so much what their earnings results end up being, which I really don't have a good read on that, but what the reaction will be. Like if they meet expectations, what happens to the stock? If investors sell off that stock hard, if they just meet expectations, that tells you a lot about what people need to see from earnings reports this earnings season to have stocks go up.
Mm-hmm.
Yep.
At least in tech. So that'll be a nice bellwether to see how sentiment changes around the actual release itself. So I'll be watching that pretty closely.
Yep.
And I expect earnings season generally to be fairly good for the S&P as a whole and for stocks as a whole, but mix in some concerns about geopolitical stuff and maybe some softening of some end markets. You could get some opportunities here for the market to give you some blood in the streets.
Definitely.
We got a question. Does stop order hunting also exist in stocks? Yes.
No.
Yes. Especially if you're a day trader. That's big time.
Yeah. And that's why I think it's you.
That's why you trade less profit.
Exactly. Like I feel like we've talked about a couple of day trades recently, and it's because you've had a couple of good opportunities, but I think it's also important to mention, like, you don't day trade all the time.
This is ironic that that I've been so actively it's ironic that it came right when I came into the room.
Yeah.
But I'm not every day sitting at my computer taking trades. It's only when the opportunities are just so blatant that you can't say no.
Yeah.
Because everything's there for you.
Bo asked about taking profits when it hits your target.
Yeah.
So this is something that we talked a little bit last time, but I have really adjusted the way that I do this now. I tend to keep runner positions on now, and because knowing that stocks always overshoot both on the bottom and the top has helped me hold positions longer. You really want to hold your winners because you don't want to end up a situation like I did with BKNG, where I sold it for a triple and then it went up another, 5-10x. Fair value is a little bit of a misnomer because it's really tricky to get in a very, very exact figure. Even when you know the company well and you do a really deep model, there's a lot of assumptions that go into the model. And so recognizing that, I typically scale in and out of positions. So, not only am I buying at different points, I'm also selling at different points. So I'll often take out some cost basis if it's up, 50 to 100%. I'll take some off the table, but then I'll keep part of the position on and let it run and let that momentum take that stock further, because it always takes it higher than you think it's going to take it, and it takes it lower than you think it's going to take it on the downside. So that's why I don't make positions full positions right off the bat, and it's why I don't sell everything right when it hits my target.
Yeah, and I agree with that. I mean, by scaling in and out, it just removes the need to be perfect.
Yes.
And removes a lot of the anxiety. And I pulled up this book. Travis, have you read this?
Yeah, it's a classic.
Yeah, there's some good lessons in here about just letting trades run.
Yep.
And even Bitcoin in 2017 was a good example of that. You can never underestimate the irrationality of the mass majority of people, and that's why, again, like you said, markets way overshoot to the downside and the upside. And so if you can get in the back of that, that's great.
Yeah. We always talk too about I love how we talk about the capturing the meat of the move, because you're just never going to be perfect with, buying at the very low or selling at the very top. So you want to,
unless you do something like that.
Yeah, right, Nikki nailed it today.
I can get away with it with day trading. I feel like I can read the price pretty well, but on when it comes to investing, I'm not so good at picking tops and bottoms.
Yeah. But you're just never going to be perfect. So you're trying to, and doing smart things like, taking some of your cost basis out when it's up a lot. I think that helps you psychologically too.
Oh yeah.
With letting some of the position ride and things like that. And not having the regret if it sells off again and things like that. So
yeah.
That helps you psychologically manage it better.
Yeah. And taking partial profits does three things. A, you take profit, right? Obvious. B, you can remove, or in some cases even eliminate, risk by moving either your hard or your mental stop above your entry area. And then you're left open for more profit, right? Uh-huh. So it's kind of the best of both worlds. And if you do all this work to find good opportunities, the last thing you want to do is get out before the trade plays out.
For sure.
And sometimes the hardest thing for people to do is actually just nothing. Get in, okay, you did the work, don't overthink it, don't get shaken out. Sometimes it takes time for people to realize that, oh, this is a good trade. And that's what you want to have happen, though, is you find it first, you get in, and then the mass majority of people find out later. And that's what drives the price in your favor.
Yeah. Bo, I don't have a specific percentage that I hold in my winners. It depends on how much it's moved, what I think it is relative to its fair value, and how big the position size was in my portfolio. So sorry to say, it really just depends. But hopefully we'll have some examples to show you in the next couple months.
Yep.
Cool. Well, we've been going for
I think we can.
hour and a half. We should probably start to wrap.
Yeah, guys. Any other questions or comments? Reading one up. Nice. Yeah, I like reading books on markets, even if it's not strategy books, but just to hear people's perspectives, and you can learn from their own experiences. And
yeah, Yeah, I mentioned Peter Lynch's book, One Up on Wall Street, I think, which was written in the early 90s. And he's a famous investment manager. He ran one of Fidelity's flagship mutual funds in the early 90s that really outperformed and kind of put Fidelity's mutual funds on the map. So Peter Lynch wrote this book, One Up on Wall Street, and it's just a really accessible book for your individual investor. And it's kind of old, but it's still, a lot of the lessons still are relevant today. So I always recommend that to beginners in stocks. And, one of the things he talks about is, being able to use what you already know to help you research investments. And I think that's a really interesting angle.
Nice. Yeah, I haven't read that one. Let me get that.
Yeah, it's a really good one. I'm reading Mal Keel's book right now. I'm not sure I'm going to agree with a lot of what he's saying, but it's a famous book as well.
What's it called?
What is the name of it?
How do you spell his name?
His last name is Malkiel. Hold on, I got it. It's a Random Walk Down Wall Street. Yeah. Got it here, actually. So
yeah, I mean, I think the lesson there is, if I remember correctly, is, basically like, how do you say it? I mean, I think the narrative that they're pushing with these types of books is the low fee ETF model, right? Like just passive, and which is probably right for a lot of people, but
that's why, I mean, I know a lot of that. I've read a lot of the research behind that, like the passive arguments and things like that. And we talked about that a lot in the first market update. Yeah, passive versus active. We talked about that in the intro vids as well, if you haven't watched those. But yeah, I love reading the classics. So this was one that I'd always skipped over because I'm like, oh yeah, he's another like passive investing guy. He's got all the, examples that show why, you shouldn't be picking stocks and things like that. But I just don't think that is right for everyone. Yeah. So, but I'm going to read it because I want to hear his arguments.
Yep. Cool. All right, guys. Also one more announcement. So this week we're going to be sending out Nikki's new course that she's been working on. It's called Maximize Your Money. It's basically all about, I don't know, Nikki, how do you want to, I'll let you explain what the course is about.
It's basically it might be some aspects might be a bit beginner for people. It's personal finance and kind of the roadmap to building wealth and the different, I don't know. I call them pillars. I
call it the foundation, right? I mean, just all the stuff that like we think, we just assume that people have in place, but a lot of people don't, right? Like tax advantaged strategies and maximizing your cash flow and stuff like that.
Yeah, basically I teach the basics of investing in high yield, investing in the stock market. I go over the basics of technical versus fundamental investing. I go through the basics of ETFs, dividend stocks, how to find what the dividends are. Just I kind of try to lay that foundation for you guys and teach you everything you need to know before you can really deep dive into the fundamental stuff further, because you do have to know the basics of how this works in the basic terminology, right?
Yep.
And then once you have a grasp of that, then you can really dive in from there. And I also touch on different retirement funds and which ones might be right for you and how to interview an accountant and just all kinds of different things to help you really round out your overall personal financial well-being.
Yep. So you guys will see that in the members area. I'll shoot an email whenever that launches, and that's a part of your community membership. So there's no cost to that. So I'm excited. I know you guys are going to get a lot out of that, and there's stuff that, we just kind of assume everybody has this stuff in place, but your biggest expense in life for a lot of people is taxes. And if you're not optimizing and taking advantage of all the things that are set up for you on that pillar of your financial independence, then you're leaving a lot of money on the table. So, yeah.
And for those of you that aren't in the U.S., a lot of the accounts that I talk about are related to the IRS in the U.S., but you can go to whoever you have do your tax your taxes, your accountant in whatever country you are, and you can actually ask them, say, do we have an equivalent of this? You know, is there some way that I can do the same thing in some type of a tax advantaged account in my country? So you can still take that information and ask some questions or do some research to find out.
Yep. Awesome. Anything else, guys?
I think that's it for now. Hopefully we get a lot more excitement in the broad market in the week ahead. And
yeah,
our next market update will really have some fun stuff to take advantage of.
Awesome.
Have a good rest of your day.
Yep. Good to talk to you guys. And we'll see you in Discord.
Take care, everyone.
Take care, guys.